So welcome. Thank you very much indeed for joining us today, everybody. We are absolutely delighted with the attendance for this event. We think if everyone who's registered turns up, we are somewhere between either 200 and 150 registrations. And that, I think, is an indication of the interest that there is in this particular topic. And are also, incidentally, delighted to see that we have a good representation of people from various different countries around the world. So that is great news. My name is Simon Osborn. I am the CEO of IFI Global. I will be co-hosting this discussion today with Jason Barraza, who's the COO of STM. We are holding this webinar today in follow-up to research that we did together on private fund managers' tokenization and adoption. I'm going to present just the headline figures because we're conscious of the fact we haven't got a lot of time. We want to save most of that for the discussion. But I'm going to present at least the headline findings, and then Jason will follow on and chair the subsequent panel discussion that follows on from that. And incidentally, please do ask questions. We love getting your questions. We will save some time at the end for those, and indeed we may well take the odd one as we go along. So before presenting the slides, I wanted to introduce the full panel. With Jason and me, we have Keith O'Callaghan, who's the head of asset management and structuring at Archax, and Sidney Powell, who is the CEO of Maple Finance. We have two people on the eastern side of the pond and two people on the western side of the pond for this discussion today. And also, before presenting the few summary slides, I should say a couple of words about who we are. I am, as I said, the CEO of IFI Global. I know conscious of the fact that many of you would never have heard of that. We are a research and media house based in the City of London, and we have 3 monthly publications and 1 weekly, and we are expanding very much at the moment our coverage of tokenization in one of those monthlies called AIS, and we are launching right now, this month, something called the Tokenization or the Top Tracker in AIS, which will be tracking funds launched in the alternative and sustainable asset classes that have developed tokenization options for their investors. And the Top Tracker will also have an investor monitor section tracking tokenization allocation information by professional investors. That's something I think really has been lacking. We're conscious of the fact that maybe not a lot of professional investors have yet done it, so it's good to get involved in this in the ground floor or indeed in the basement. But as I say, that is all coming now. It will be out. This issue with the tokenization tracker will be out before the end of this month. Right, on to the research. So as I already said, this is a very brief summary. Much more detail on the results will be in the same issue of the publication I just referred to, AIS, which, as I say, should be out before the end of next week. And we did this to get the results into, for want of a better term, some kind of a balance. We decided to use, in effect, 3 sources for this: desk research, as well as personal interviews with some managers, GPs, and also this significant proportion was sending the questionnaire out to the market. And this was all to GPs in private stroke sustainable asset classes. So let me quickly go through these headline results. Are you considering developing a tokenization option for your strategy or strategies? This was surprisingly high number we got, 74%. And let me caveat that straight away. Inevitably, when you do research like this, whatever the way of doing it, you're going to get a bias in favor of those people who are doing it. So I don't think it's anything like 74% of the market of private fund managers are looking to yet do tokenization, but those were the ones who would have been more readily interested in taking our calls, responding to our research, etc. So having said that, though, if we had asked that question 2 years ago, I don't think that figure would be anything like as high as 74%. So what are the drivers, or what is the driver for this? And on the questionnaire, we had another option, which is anything else do you want to say? Just fill it in. No one really filled it in. So those were the main three, or pretty much exclusively the three reasons why people said that they are looking to adopt tokenization. Reduce operational costs, 65%, significantly the highest expanding investor base, and also a slight majority saying they were doing it for enhanced liquidity. Bear in mind, we were not going to where we know most tokenization of funds is taking place in money market funds and things like that. We were really focusing heavily upon the illiquid alternative asset classes and the sustainable asset classes. Right. What strategies are you considering bringing on chain? And when I first put these slides together just a couple of days ago, I was thinking of putting the actual numbers in with this, and then decided that I wasn't going to do that because they were actually completely ridiculously lopsided. Real estate was way out by a country mile, was way out ahead of everything else. And from commodities down to infrastructure, there really wasn't really much difference between the results in terms of responses or the field work or the desk research that we did. So I think a lot of this, and we might get into this panel discussion in a minute, will be how much can those other asset classes, and indeed other ones that aren't on this slide, can catch up with real estate. That is being the driver, I think everyone would agree, by a substantial degree in this particular area of the market. And we may get, as I say, into that in a few minutes. Finally, we asked the question, do you intend to do this by either adding a tokenization option to an existing fund, or are you looking to launch a new investment product? As you can see there, the majority are looking to add some sort of tokenization wrapper onto something they are already doing. That is largely what the existing managers, well-established managers, the names that you would have heard of, are most likely to be doing. The ones that are launching from scratch, maybe even their business, or certainly launching a whole new product, whether they've been around for a long time or not, tend to be going down the other route of launching just a tokenization option. In fact, Jason introduced me to someone not that long ago who is a renewable manager. I think I'm right in saying, Jason, he's just doing tokenization for his particular investment product. And I think we'll see more of that as time goes by. So it's people who are coming into the market for the first time may well go down that particular route on a very regular basis. So that is the end of my very fast, quick ramble through of the summary of the results. As I have already said, we will have those in more detail in the issue of AIS that will be out next week. So I'm now going to hand over to Jason, and who's going to do the moderation of the panel.
Awesome. Thank you so much, Simon. It's been a pleasure working with IFI Global on this research, and I know we're going to continue working together in multiple facets. But culminating everything here for this webinar, I think it also was important to bring in perspectives from those that are actively building in the space and bringing on assets on chain, right? So we also want to thank Keith and Sid for joining us today and providing some insights that we're going to dive into. With all that in mind, reminder, this webinar is about private market assets. We're not really looking at the tokenized treasuries that we're all aware are doing extremely well, right? But with that said, maybe to kick it off, Sid, Keith, which 2 to 3 private asset classes do you think have made the biggest strides toward practical tokenization, and how are you guys kind of gauging that?
I can go from, kind of the practical Archax perspective. I know you mentioned that this is, kind of a private fund, private markets type approach, but in terms of the traction that we've seen is really in terms of money market funds and treasuries. Like high price discovery was always going to be the first mover in these things, and then you get your high price discovery that allows you to actually then have trust in the actual token itself, for collateral purposes, and that's what we've seen. The main use case, first phase, was people going into treasuries and money market funds, and then once they were comfortable with that, then utilizing that then in terms of a mechanism for settlement, for collateralization. And that's what we've been building as a kind of a first case. And then it's then evolved, as people have got more comfortable, as we're kind of moving into areas like commodities, real estate, voluntary carbon. I think probably voluntary carbon is probably a very interesting space, just in terms of the size of the market, its relative dysfunction as an asset class, and I believe that tokenization, like, I think I'm probably most excited in that area, that area of the market, as it comes to the fore.
Yeah, just to build on what Keith says, so definitely I think money market funds took a huge lead over the others, particularly from kind of early 2023 onwards. What we've seen on our side at Maple is the second and third would be receivables. So we did see some demand for receivables because they're very short dated. So, they can potentially turn within 30, 60, 90 days. And most on-chain investors have a very short, liquidity preference. They don't want to be locked up for more than a year. Plus, you had the high yield. So it was then they felt like they were actually sort of being compensated for the risk that they were taking. And also it was favorable versus, or it was at least beating the hurdle of other alternative places they could deploy on chain. And then the other one would be secured lending, which I guess falls under a private credit. But we've seen, the amount of lending on chain is still quite a way behind where it was in 2022. So I think there's a lot of room to catch up there. But a lot of folks are comfortable with loans that are secured by, digital assets as a form of private credit that is, again, succeeding because it's short duration, over collateralized, and is paying a yield that, is beating money market funds or other alternative places these people can deploy.
Both of those make sense. And I know private credit has really grown a lot, both traditionally off-chain and on-chain. Maple has been doing this for a while now, I think 2021, maybe earlier, right? So, what structural features of private credit are making it more of an early mover, and why is it still lagging behind other assets as well? Just curious more on your thoughts. Maybe it's a collateralization and visibility into it or other, but curious, Sid, what your thoughts on that.
I think it's been successful so far because it's a largely OTC market in traditional finance. So there's not there's not a standardized form. There isn't a liquid secondary market. And I think those have been some of the obstacles with other asset classes, is that people are less satisfied with the on-chain version of an asset class that already has substantial secondary market liquidity and a very standardized form in traditional finance. So I think that has really helped private credit to find its way on chain. Then I think that the fact that its target return hurdle is going to be higher than typical investment grade credit, I think has also helped it come on chain. The reason I'd say it's lagging further behind is that private credit deals, particularly in the institutional space, tend to be much larger in size. So you do need larger, more institutional balance sheets to participate and really to bootstrap the market. And then it can be, there can be an educational process where it's not necessarily the easiest asset class to due diligence. It does require some expertise. And so I think that has kind of limited it from perhaps broader retail adoption so far. Versus something like buying a tokenized version of SpaceX, which has very high brand recognition, and the people buying it have a much higher risk appetite than typical credit investors.
Makes sense. Right. Go ahead, Keith.
Yeah, so I would say, we approach the market from a slightly different angle on that. We're really kind of providing a lot of services and structural. So where I'm seeing probably under the current of what maybe you guys would see is that we're acting more and more now in the form of a kind of an escrow agent. We're a custodian as well. So this private credit, it's kind of it's kind of appearing from our perspective, obviously on the fund side because we deal with all the major asset managers, but actually in the practical side where we're acting in essentially as a kind of a tripartite escrow agent where you've got digital assets and you've got a lender and a borrower and they're securing that. So in a sense it's the operational private credit market, and it's started to go from nowhere to somewhere, fairly rapidly over the last 12 months, so it's not a very formal market. It's very OTC. It's OTC squared, but, it's an interesting direction that we can see as a service provider that this is starting to happen, but it'll get, obviously Maple and people in that area kind of codify and structuralize around that, so that's where I think the direction of travel will be going.
And based on the clients that you guys are working with, and the users on your platforms, what are you guys seeing in terms of, signaling real traction versus like pilots and POCs that we've seen a lot of in the past?
I can go first on that one. We have seen on receivables finance, we did 25 mil of inventory or of allocations in 2023 and 2024. We've seen appetite kind of pare back for that just because a lot of other lending activity in the space has kind of taken its place. So just basic lending against over-collateralized digital assets. And then private credit, I mean, we have almost $1 billion sort of loan book outstanding at the moment. And so I'd say we've seen relatively large amounts of appetite from on-chain allocators, be they corporate treasuries, hedge funds, high net worths, family offices, to invest in that asset class. So I think that's kind of hitting scale. And then on the real estate side, I think Provenance and Figure have done a relatively good job of reaching some kind of scale with that asset class. So I think there are pockets there, but it tends to rely on a very robust buy side of the market, and I think that's been the main kind of obstacle or filtering function for what is successful. And I think the more exotic asset classes tend to have a very niche set of investors, and so it can be tougher to get that kind of initial critical mass of investor funds or investor capital to get those off the ground. I think that's why we see some of those kind of I guess be slower to scale as far as tokenized opportunities goes.
Sid, since you just raised that point, and I said we might throw in the odd question that's coming in. We've already had two questions in, interestingly enough. The second one of the two here is kind of on the point you just asked. So this might be a good time to raise it. Is tokenization turning out to be mainly for private investors, not professionals? Is somebody's asked that question?
I think it's a very good question, and I would say my answer is that the early adopters are the private investors. So when I refer to the receivables tokenization funding that we've done, or the funding for tokenized receivables that we've done, that was largely private investors who were subscribing to that. And I think that tends to make up your early adopters of these on-chain products. And then it's once it reaches scale that you get professional investors who come and allocate to it. In that instance, it was actually the private investors eventually got refied out by an institutional fund that purchased the assets. So I think that's kind of sort of perfectly illustrates the progression where the high net worths have higher risk appetite. They are seeking, higher yields, and they're faster to make investment decisions because it's often, a single principal at the family office versus your institutional allocators. There's much more of a committee process. And so, any one objector who doesn't really like the idea of doing it on chain can kind of derail the allocation. So I think that's why they take a little bit longer to do. But the trend is we are seeing more institutional professional interest over time.
I would say from the Archax perspective, we're again from we're a different part of the market to some extent, you know. So we're generally dealing and facing off against TradFi institutions that are looking for a way in, but they don't want to go 2 feet in, you know, so they kind of find this middle ground with Archax. And what we tend to do normally is actually lock assets and solutions into existing products that they already know, you know, like structured notes and AMCs and things like that, and then it allows them to kind of get exposure to the asset, especially on chain, through these structures. Like we've had a number of requests to actually tokenize the actual securities themselves, you know, so the structured notes or the ETPs and that, you know, so that's kind of early stage, you know, and that really requires a you know, market makers to move in properly into that segment of the market, you know. So I would say we are seeing, I would say there's an element of sea change just in terms of the dialogues that we have, you know. So institutions now aren't kind of asking what blockchain is; they kind of know what it is. You know, you meet groups that are building digital teams in some of the largest asset managers that were maybe, you know, kind of slow to the slow to the start line, you know, and they're really starting to catch up, you know. So from our perspective, we're seeing, you know, increased traffic, you know, slowly increasing revenue, but really it's actually using old school structures that we've used for 20, 30 years and just kind of, you know, stuffing digital assets into them and then, you know, hopefully in time digitizing that output.
So a lot of what we covered so far is really, you know, again, the private investors, individuals, you know, participating here, trying to conform to institutional as well, you know, depending on the structure that's needed for the asset, for the technology and all that. I do want to change focus a little bit because I think there's another side to this, right? You have DeFi rails that are also starting to come into play with these private market assets. And so just referring to the survey we had here, right? 53% of the surveyed answered that they were driven by enhanced liquidity to tokenize their strategies, and then 88% for an expanded investor base. Now, as a lot of us know on this webinar, you know, tokenization is not a magic wand and all of a sudden investors appear. At the end of the day, it comes down to the asset. That being said, we also see people looking to expand that investor base and drive liquidity through other means, and DeFi is one of those tools. So what are you guys seeing in terms of tokenized RWAs, real world assets being plugged into DeFi liquidity venues, be it lending pools, AMMs, DEXs, while still remaining compliant, though, with KYC, AML requirements and so forth?
You want to go first, Keith?
Okay, I know. So from our perspective, you know, we're our clients are, you know, are essentially the issuers put a lot of trust, you know, and it's fed out in the contracts we sign with them, where we take, you know, the bulk of the responsibility in relation to AML, KYC blowback, you know. So like in essence, if things go wrong, you know, it's our maintenance of sanctions lists within smart contracts, our maintenance of whitelisting within the smart contracts we create for the issuers that we work with. We're, you know, so we take a lot of responsibility there because a lot of them are extremely worried, either through just lack of knowledge or, you know, they're worried that they're going to be exposed to a sanctioned wallet, things like that, you know. So I think that's slowing things down fairly substantially. So generally what we've been doing is like we do create stable coins which have a lot more flexibility. You know, I think they just go out in the market, they work under a sanctions list, you know, that we maintain, and, you know, they're obviously involved in the DeFi market just by their own nature. In terms of the hard assets that we're putting out there, really, you know, things like uranium and other commodities, those in essence are a bit more controlled, you know, and their ability to go into a proper DEX environment is somewhat restricted as yet, you know, because in essence no one wants to touch, you know, sanctioned wallets, you know. So unless you're getting a DeFi pool where you can completely guarantee that, it's going to be hard to expand on that, you know. So, you know, like the market is adapting. The market is adapting, you know, the solutions that we're seeing coming to the fore, you know, but you know, like we're still kind of in this middle ground where our stable coins fly out the door and all of our other assets are slightly slower in terms of their ability to really be deployed into proper DeFi.
Yeah, on our side, so we have an institutional gated product that folks can use where they go through KYC to to deposit to the pool, which is whitelisted. And then once they're in there, it's like a fixed income product where they receive yield from over collateralized loans. And all of the loans are made to institutions that go through KYC, KYB, and sign an enforceable loan agreement so that we have recourse to them if the collateral is not sufficient to cover the loan balance. So a lot of our institutional clients typically go through that avenue in order to participate in the product. We do have a more DeFi kind of permissionless product as well, which is walled to offshore from the US, so it's not available to US clients, but folks outside the US can use it, and that has given it an opportunity to have more composability. So it can be posted. You can effectively use your LP share or your LP token, which is a receipt of your holdings, as collateral, or you can sell it on a secondary market, or you can hedge the interest rate risk in an interest rate market. What we find is we also, similar to what Keith was talking about, we use wallet screening tools to kind of prevent sanctioned wallets from using our platform. But by and large, the commentary we get anyway from these forensic analysis people is that most sanctioned wallets don't really use savings or yield or credit products, because their goal is they steal and then they try and off ramp into the banking system, where it's much easier to kind of have opacity rather than being on chain. And so you tend to have much lower risk of interacting with sanctioned wallets in lending and yield protocols, particularly those that have permissioning in place. And so that's honestly how most institutions get comfortable.
Yeah, that kind of answers one of the questions that also came in recently, which was, even in private markets, regulation appears to be one of the real challenges. So people were asking how you guys are kind of tackling that, which I think you guys kind of just answered here. And then just from an asset manager point of view, what questions do they bring or raise to you guys as they have those conversations, whether to bring their assets onto your platform or to participate?
I can say from our side, we do get an incredible amount of walk-ins, just people looking at their asset and then coming to us and saying, is it viable? So like we do have a fairly caustic approach to this, because you need to understand from the asset manager's perspective, like why they want to tokenize. It's like the principle of if it's an inappropriate asset, tokenization won't make it a better asset. So like there are advantages in terms of like distribution, kind of a broader client base, but like at this stage, depending on the nature of the asset class, it's very much an enablement discussion rather than a direct, yes, you are going to raise extra money because of this. So once people are realistic, and you have that conversation, you're kind of you're good to go. We always do say to asset managers and people with issuers, just do it. It's not that expensive. It's not that expensive to get your fund on chain. We either work with the transfer agent or we issue beneficial ownership tokens, on behalf of the issuer to the market. So that's not very expensive. So and the amount of IP that the asset manager will generate just from that experience, just kind of go do it. Don't wait until everything is lined up for you to do it. And that's in fairness, that's what most asset managers have been doing now. They've been just going for it.
I think my job here, this afternoon, is to sort of monitor the questions that are coming in. And Keith, since you've got the floor there's one that kind of follows on, I think, a little bit from what you were just saying. Someone's just asked the question specifically, what stable coins has Archax issued?
So we don't issue stable coins. We support issuers. So we have a number of issuers, but for example, there's an issuer called Deep Blue coming to market, which we've supported since their inception. So like all we do is we provide the tokenization, reserve management, the regulatory approval, and all of these things. So we're not an issuer. We don't intend to be an issuer, but we work with issuers who want to come to market using whatever currency stablecoin, and we help them structure it.
Okay.
So we've kind of covered like private market asset classes and what we think are kind of the furthest strides here. We've then talked about DeFi and its applications, which I think you guys are doing some phenomenal things there, and it's only going to grow. That being said, there's still plenty of obstacles to capture still or to overcome, and there are catalysts to be expected as well to bring things going. So I know we touched on it lightly earlier, but I do want to revisit the buy side conversation in terms of participants that you guys are seeing. I know you mentioned like endowments and treasuries, but any additional light that you can shine on that? On participants in your on the buy side, and what else do you guys think we need to do to encourage them and educate them a little bit more around tokenization of these assets?
Well, I can, as I mentioned, like a lot of our success has been on the more liquid, higher price discovery assets. And from that perspective, we have, quite interesting large institutions, involved in this. And they're looking at it, as I said, the first step was tokenizing assets and them holding tokens and getting comfortable with the concept of, a tokenized version of this asset. And then their next step was logically, okay, how the hell do we use this to make our business better? And like our Nest protocol is essentially a collateral transfer network between large banks. So I find it extremely interesting that banks that you wouldn't necessarily perceive as being really interested in this kind of digital space so early, they're in there transacting as we speak. Sending collateral back and forward, testing.
Keith, I think he's just frozen there.
I can pick up the answer. So in terms of folks we see on the buy side, so endowments, pension funds, a little bit slower. I think one of the risks they have is that a pension fund can't really change its allocation strategy to it. So very often they're just totally unable to do anything in digital assets. It takes them like a year to update their policy, and has to go through like almost like a legal review, as in like a legislative review. So where we see the most adoption is high net worths, family offices, and then the increasing participation is coming from corporate treasuries. And then we're seeing a lot from professional asset managers who might be representing a foundation. So it's got funding from a capital raise that it did, or from some other from some other purpose. It might have been set up with a specific purpose in mind, say to further the adoption of a certain chain or asset class. But it'll have professional asset managers who are managing the allocations, and that they've been a big client for us. And the other one has been on-chain protocols. So we actually have a lot now coming in from whether it's like Binance's wallet program. We've spoken with other centralized exchanges about giving their users access to our platform, and then we've also had allocations from stablecoin issuers who consider it as a strategic. It's a strategic avenue for them to increase adoption of their stablecoin by allowing institutional loans to be funded in the and denominated in the stablecoin. So I think that's been the other interesting angle. So high net worths, family offices, hedge funds, foundations, and then now stablecoin issuers more and more.
So can I ask you, on the back of what you've just said there, do you yet see that there are investments happening simply because there is that tokenization adoption that's been made available that would not otherwise have been made from those investor groups, or with those endowments or corporate treasuries or high net worth or family offices would have done it anyway? It's just a more convenient way for them to do what they already did. Or are we beginning to yet see developments of that asset class because it's, or that fund or that strategy, because it is tokenized?
It's a good question. I would say for the protocols and protocol treasuries, you're seeing them invest in money market funds because they've been tokenized. So it's interesting, like the largest holders of BUIDL, which is BlackRock's tokenized money market fund, are indeed protocols. It's Athena, the Sky/Spark ecosystem, and Ondo, and those are the three largest kind of wallets holding it. So those, investors would not have been participating were they not tokenized. But I think in our product, which is predominantly over collateralized lending, I would say it's more because it's a product that you can't go and buy from Morgan Stanley or from BlackRock. And I think that's where we found a much more sort of fruitful avenue to explore is what can we provide that you can't go and buy off of Wall Street today, and use that as a selling point rather than having to sell them something they can already buy and try and appeal to the novelty factor of just doing it on chain.
A couple things on that actually that intrigue me. One is your example on Biddle, right? And the fact that Ondo and others are building on it. It kind of allows for retail exposure to Biddle without holding the Biddle, right? Because if you own like Ondo's OUSG, it's very basically the same. Right. So more retail access and flow that way. So essentially you have institutionals that are essentially, creating products for other institutions, and then you have people building on top of that.
Yeah,
The thing-
B2B2C,
What's that?
B2B2C.
B2B2C, exactly right. And then what you mentioned there, Sid, is really interesting on like this is only available on chain. And I'm curious to hear you guys' thoughts as, more private market assets that are traditionally very illiquid or inaccessible as they become tokenized and liquidity flows into the ecosystem in the next, call it 5-10 years. What does the future of like portfolio construction or custom structured products look like? What do you guys envision?
I can give probably from my perspective, my historical perspective is that I used to run hedge funds for most of my career, working in hedge funds and then running a hedge fund business. And I'm a TradFi guy as they come, and I used to set up my funds and have my board of directors, administrators, all of these things. And I remember a few years ago when the Archax guys, said they were starting up this business and they talked about DAOs and voles and that, and I just said that that's sci-fi, and now I come to the other end, where I can see, from being a kind of a person who runs funds and is active in that, how like, we're structuring our own DAOs, we're structuring, was it voles, all of these things. So ultimately, the way I see this, and it's something that I think the fund administrators are very aware of, is that we're probably moving in time, once the lawyers and legislation catches up, we're moving from what we would have considered the standard 40 Act, UCITS, hedge fund structure, all of these SPV structures that we've created with huge amounts of friction, huge amounts of like cost friction, operational friction, transparency friction, all of these things. I can see that they can be dissipated away, where now you will, as an investor, on an individual basis or as a kind of collective investment, you will go in and you will be able to transact in the underlying instruments themselves, rather than, this investing in essentially a blind SPV and hoping for the best, So I do think the way we do business, especially the way we as hedge fund guys used to do business, is going to change, and the way the market is structured around, fund administrators and in these type of legal structures, eventually, because the technology is there now to start changing that. I think that's going to happen. Maybe not as quickly as people anticipate, but it's definitely in the pipe, because if I can perceive it, and I've spent the bones of 30 years doing it the old way, and now I want to do it this new way, it kind of I think there's a directionality on that.
I think what I'm seeing, or what I'm expecting to come through in terms of structured products, will be structured products built on Bitcoin is probably the where we're seeing the most appetite at the moment. So structured notes obviously had experienced huge growth in traditional finance, and that market is relatively well cornered by the likes of JP Morgan, Morgan Stanley, and traditional asset managers. But we have seen a more differentiated product starting to come through, which is structured products built on Bitcoin and digital assets. We piloted one earlier in the year where we could give people, effectively, we could take US dollars or stable coins and then offer a floor 4% yield. So you're keeping up with T-bills. But we could give you an upside APY from appreciation in Bitcoin. So we'd buy a call spread, layer that on top of an over-collateralized loan, use the yield from the loan to buy the call spread, and then you could get up to 35% APY if Bitcoin appreciated. Now, timing of the product wasn't perfect. Earlier in the year, obviously, Bitcoin was kind of going down into the to the low 80s and high 70s, and so we didn't get a lot of uptake on that product. But interestingly, one or two people did buy it, and now that Bitcoin's gotten back to where it is today, they're going to hit their full sort of 35% APY. I think it's a product that's kind of well suited to bull markets, but I do expect that you will see corporate treasuries and family offices buying that type of product because they're at least keeping pace with T-bills, which would have been for the most part their opportunity cost. But none of them want to actually buy Bitcoin outright because they don't want to take the risk of a drawdown. Whereas here, their risk is kind of capped, floor of 4 and then upside of 33, and they all ultimately have exposure to the crypto market anyway, kind of operating in the space. So anyway, I think that's kind of an early set of adopters, but I expect more structured products like that to come through.
Yeah, just maybe to finish off on that, like we do deal with structured product issuers, and we have seen now this pattern of, interestingly, people kind of putting Bitcoin into like a fairly, what would be considered fairly standard boring note, and they're putting Bitcoin either unhedged or, with maybe an ISDA, some ISDA floor based into it, that, and they consider it really as a treasury asset, for the investors to take some form of exposure. And the other thing then is like Archax is also a securities exchange. So, we have a number of potential, we have one company at least and a number of potential others that are Web3 based that will hopefully give investors exposure into kind of, some form of delta exposure to the treasury management of the balance sheet of these companies, but also kind of Web3 exposure into, the ecosystem of certain protocols. So it's like there is an evolution I see, from direct crypto exposure to options to structured products to now equities, like not necessarily micro strategies, but that kind of equity type exposure where you as an individual who you don't really want to touch wallets or you don't want to touch crypto, but you want to hold essentially a security and all the benefits and the protections that a security normally gives you, So like we're seeing broad-based evolution, and some of it will work, some of it won't.
Yeah, MicroStrategy is probably the proof case of the appetite for structured products. If you look at what they've done to their capital structure, they obviously had, 6 or 7 years ago, they just had common equity at the base. Now they have preferred equity, convertible, two different types of convertible debt instruments. And then for a while, they even had a line of credit over collateralized with crypto. But I think they illustrate the appetite of professional investors for some of these structured products.
Really cool. Yeah, no, 100%. I think it's to what you guys are saying, right? In other conversations we've had too, it's, start with kind of like the go-to blue chip, if you will, the Bitcoin plus an RWA of some sort. Eventually, of course, it'll evolve. But this is what we're starting with. I think these are really cool use cases that are going to open up people's eyes to, what else is possible. On that end, Keith, you mentioned earlier you kind of come from that TradFi world and you thought of DeFi and all this good stuff as like sci-fi. So curious from your perspective, what are maybe some of like the biggest misconceptions that you've now overcome as you've spent time in the tokenization space that you think traditional people still kind of, think about? And the other thing as it relates to DeFi specifically, I know we've talked about like leverage loops in the past and whatnot. How do you reassure traditional allocators this isn't like a rehypothecation spiral or anything else like that?
Yeah, I think probably the most common misconception around tokenization is this kind of road to immediate liquidity. Ultimately, if you've an instrument that's got low price discovery, it's indicative that it's going to have more difficult liquidity. I do believe tokenization is a step towards that solution. But if you go into tokenization purely for the thing that you can't raise assets in the traditional way, so now you're going to raise assets in through tokenization, I'll tell you now is that the crypto market is as smart or smarter than the TradFi market. So you're not going to, if you can't fool the TradFi market, you're not going to be able to fool the blockchain crypto market. So I think that's the fundamental point on it. But there's clear benefits in tokenizing, these type of assets. We see it, people taking different angles on why they're touching credit, in terms of categorization, kind of fractionalization, all the usual things that you'd expect on that, So where, was it, so, but the main thing we do say to them is that if, this is a stepping point, I do think certain assets, I think I mentioned carbon, voluntary carbon market, very dysfunctional market. I think it's primed for tokenization. If I looked at all the asset classes I've ever looked at, that would be the one I would has said years ago that this would be perfect tokenization. Really hasn't happened yet, but I think it's we see a lot of projects now from our side that are kind of with serious people, who've got a serious view of how they're going to deliver on the voluntary on the carbon market. So I think that's quite interesting. Then in terms of the your second question in relation to the DeFi side of things, it's really about I would say we haven't gone down the rabbit hole too much, in terms of like our OTC desk will offer variable, yields. That yield can be, tokenized money market funds, and that can ramp up into kind of borrow lend on coin, and that's us really just facing off against LPs. And then we do some form of kind of like stablecoin LP structures and the like, but it isn't super aggressive because we're a regulated firm. We've a football team, we've a compliance team, so to get them comfortable about all the next steps, we have to really operate within wall gardens at the moment. We try to make these wall gardens as big as possible, but there is a limit to a wall garden. But yeah, so that's I think probably Sidney has probably got a better take on that particular DeFi point than I would.
Can I chip in and say that I'm very conscious we've got only really not much more than 10 minutes left, and we've got a lot of questions here. Shall I jump in and ask, unless Sidney, you want to answer that point that Keith just raised, and then I'll chip in with some of these questions.
Sure thing.
Yeah, happy to. So I think in the walled gardens we have seen some attempts at this. Probably the most notable recent one has been Apollo tokenized a private credit fund and then integrated it with a DeFi lending market called Morpho, in partnership with Securitize. And so they were able to ensure that the funds, what was happening is that the ACRED LP shares, which were in a tokenized form, could be pledged to borrow to buy more ACRED. So you can effectively loop it to enhance your yield. And they found a way to ensure to create a permissioned walled garden in which only accredited KYC funds could supply the lending capital, in which only accredited KYC parties could perform liquidations if the collateralization were to be breached. So it is happening. It's actually a very well trodden path now. And so I expect that to kind of happen more and more, but that is one way that they ensure that that only sort of KYC individuals can participate or interact with the tokenized securities.
Love
Okay.
it, love it. You have to have those risk controls in place, and I know Gauntlet also has, on-chain essentially.
Gauntlet is the partner for that one. So Gauntlet is running the Morpho lending market for ACRED.
Perfect.
Okay,
Go ahead,
I'm going
Simon.
to maybe pick out just a few questions here, and please feel free others to chip in because you can all see them as well. One is, somebody's asked, are your tokenizations fractional or whole? In other words, if it were a receivable, is it one for one, or is the receivable fractionalized? And if you have fractionalized, what safeguards do you put in place to protect against oversubscription?
I can say from our perspective, we've fractionalization is allowed, it's allowable. Generally, was it the issuer will pitch the size, or the size of the token value at a level that's appropriate, but in essence, there's nothing like from our perspective, depending on how we issue the token. If we're issuing a mirror function where we're acting with the transfer agent, then the transfer agent has the legal responsibility to essentially ensure books and records. If we issue as a custodian or as a trustee, then we're issuing legally enforceable tokens, and therefore we have the obligation to make sure that the cap table and that the ownership is maintained. I think with RWA assets and specifically with security assets, there is a huge level of control by the issuer, the transfer agent, or Archax. If, for example, a wallet's hacked, we will go in and we will, well, we haven't had the instance to do this, but we have control over that that token to burn and remint, as it relates to securities. This doesn't obviously work in stable coins fundamentally, it's a different type of asset, but the more you go to securities, you just cannot, you have to have like a very high level of control over this.
Unless anyone else wants to chip in on that, there's two similar questions. One, somebody's asked about saying we're looking to get information on tokenizing real estate. And then somebody else has asked a specific question about forestry. And it's interesting, Keith, I think you were just talking about the carbon market a minute ago, because carbon credits go very much with forestry. And they see that, I think, as an opportunity to make that particular asset class a lot more attractive. But both questions were about where can you go to get information on that, on how to do it, and the options and so on and so forth. Does anyone know the answer to that question?
Well, I would obviously say, come to Archax and have a chat with us, but there is like some really great firms out there, you got like DigiShares, Tokeny and all of that. So like, I would always recommend speaking to at least two counterparts, for pricing, quality, whether you believe their story, especially because the more this asset, like the asset itself mightn't be regulated, but the way you manage the asset or you put the asset in the SPV, it could imply it as a collective investment scheme, which then brings it into, in our jargon, it brings it into MiFID, and then that means you're back into securities law. So you do need to be very subtle in terms of how you construct your SPV, how you structure issuance, because you can trigger yourself from being non-regulated into being regulated, so these are nuances, and you need to work with tokenizers that have a kind of a deep bench in terms of regulatory and the like, but I'm not a sales guy, so I'm not even going to continue on this. So
yeah, quick note on that. We advise security token advisors. We help people go through a tokenization process and kind of go through selection and structure and all that good stuff. So feel free to send me a message. Otherwise, we do have a whole report available at reports.stm.co on tokenized real estate specifically, if anyone wants to check that out.
Yeah, these people are asking the right people the questions, and you guys could answer on the forestry one as well. And do you see that? I don't know how much you know about forestry as an asset class, but have you been following that? They think that with carbon credit market developing on as a tokenization option, adding that to forestry really does make that asset class a lot more compelling. And it hasn't really done that much. It's always produced a positive return, but it's been pretty disappointing in comparison with most others. It's been pretty disappointing. But the fractionalization of forestry potentially could be very interesting. I'm adding on to what this person said in his question or her question, and so I just don't know whether these are areas you guys get involved in.
I can speak a bit to this because it's an area that we've been involved with for a while. So, like, we're not going down the rabbit hole because we're short on time, but essentially, historically, afforestation and Red Plus were the two core elements of carbon or VCUs, and basically they got absolutely trounced and trashed by the Guardian and other people in terms of the quality of the project that was there. So that's really upset that market. The markets, from what we've seen, has started to orientate itself towards scientific carbon credits, where, it's carbon capture, recycling, things where you can say, okay, scientifically, this is exactly what's there. So I think forestation definitely has a place. It just needs to reform itself, taking into account the fact that it wasn't maybe as well done in the previous 20 years. It wasn't really well done. If you do it now and kind of lock in this kind of proper scientific approach, I think it's a perfect asset for tokenization, as all carbon credits are.
Yeah. Right. Well, we've just got a few more minutes. Should we, Jason? Do you want to? Shall I carry on with these? We had about 12 questions in. Do we want to carry on answering them, or do we want to, in our remaining minutes? What do you want to pick one out we haven't done? How do you want to do it?
Honestly, let's do. We have 5 minutes, right? So let's do a fire round. Just see how many we can crank out. This is for the audience.
Or should we do fast ones then? Yeah.
Yep.
Okay. Do you want to? Okay. Do you want to read them out, the ones we haven't done, or?
Sure. Yeah. I'll kick it off with one of these. Let's see. How to raise a VC fund partially through tokenization, knowing this is a liquid product and the portfolio companies need money. Also, in case of fund distribution, how will the money be transferred to Token? So essentially, quick high level on how to tokenize a VC fund and how to make distributions on chain?
Can you guys do that in a minute?
Well, yeah, well, the distributions are easy, assuming that everyone's digital, you'll do stable coins, you do airdrops of the of the tokens. In terms of VC, you've got to have like some subtlety in the smart contract because it's a commitment rather than a direct draw, so you'll be making capital calls, so it's a relatively straightforward thing. It doesn't actually dramatically change from what you would do in the TradFi world from a fund administrator perspective. So, yeah, I don't know, did I really answer the question, but there you go.
Do you want to read out another one, Jason?
Sure. Yeah, it was mentioned that we might see less and less of the UCITS type structures for investment funds. Is this a threat to the legal and regulatory bodies governing financial services law, or what opportunities do you see emerging in the coming years in this regard?
Well, the thing is that UCITS is the world standard outside of the US. US is 40 Act. UCITS is the world standard that everybody uses. The Europeans are very good at creating this type of legislation. So UCITS will be with us for decades. However, the form of the UCITS in terms of its ability to create itself into essentially an automated smart contract, I think that's where you'll still have the legal construct and all of the obligations because running UCITS is a very difficult, costly thing to do, but it's a very safe vehicle for investors. So you're not going to throw out the baby with the bathwater. You're just going to change the way it's implemented and hopefully bring down the cost friction and all of these things and make the market much more available and allow younger asset managers to come in and not be absolutely subsumed by the big players.
Anything you want to add, Sid, to any of the questions we've asked so far?
Yeah, do you guys want to pick out things you see that we haven't answered and answer them yourself? We got a grand total of 3 minutes.
Just there's a quick one there. Do you offer broker-dealer services? Yes, we do, both in securities and in crypto. Okay. It's that one. Over
the secondary market, we don't offer a secondary market ourselves, but for the permissionless, like the more DeFi native product that we have, there are secondary markets out there for it. So there's Uniswap and some of these other on-chain aggregators. So you can get instant redemptions if you want. We found that's been a big sort of improvement in appetite.
Another one, Keith, you talked about, reminting, right? So reminting after theft implies you're using NFTs instead of fungible tokens. Is that correct? I'm gonna guess no, but
no. So like in essence, what you have is as it relates to security, when people have to come back and secure the asset, they can sell it in the secondary market, but if they have to come back and secure the asset, they was it like they go through the full AML KYC perspective. We haven't dealt with a situation like this yet, but ultimately we have full control over all of the security tokens that we issue, as part of our service, and that's either us directly, being managing that token issuance or working with the transfer agent, and we receive instruction from the transfer agent to do whatever the transfer agent wants us to reflect on chain.
Awesome. And I have one last question of my own for you guys before we call it here. But what tech element, whether it's custody, on-chain identity, reporting, Oracle data, whatever, what tech element do you think it still feels a little bit in beta and needs really like an institutional level upgrade before the markets can scale?
Well, I think we mentioned it like numerous times. It's the KYC AML solution. I think what we're doing at the moment is we're trying to build the biggest walled garden we can get, and we're doing that by obviously taking clients on board ourselves, but then locking into other counterparties. Like let's say for example, a Maple, we would vendor onboard them, and we would kind of hopefully lock into their walled garden and connect to our walled garden, and us being kind of institutional firms, we can act together in that, and it doubles the walled garden. But I do think it can't be just firms trying to essentially interconnect themselves. You need regulators to come in and set standards. And I also feel that you need to have the layer, you need to have the protocols themselves coming in heavy and hard, on this type of KYC AML. And then we all approach the regulators at that point and say, look, this is bulletproof. We want to create essentially the infinite walled garden, where we get full identification, we can interact, with clients and not have the very heavy onboarding requirements that we always have. Sorry, Sid.
KYC AML. And Sid, how about yourself?
Probably custody, I guess. I think a lot of the custody solutions we see are kind of a lot. It can take your clients 3 to 4 months to get onboarded with them, and so that just kind of slows down the deal flow. So I think it's getting better. It's just a bit of a friction point for our clients.
Fantastic.
Well, listen, chaps, I think we've hit the witching hour of 6 o'clock in London and 1 p.m. in Miami. So, and I can see, I think the numbers are dropping for obvious reasons. So we probably should call it a day there. But thank you very much, all of you. First of all, those of you who are still there out there following us, and Sidney and Keith, and indeed my partner in crime, Jason, on this whole project with the research, as well as this webinar. As I said at the beginning, there will be more details on the research in our June issue of AIS, where we're launching this tokenization tracker, and we will have that in the investment monitor as well. Some of the stuff that Sidney and Keith and Jason were talking about will be part of that as well. So from my part, thank you very, very, very much indeed. Have a great afternoon or evening, or wherever in the world you are, whatever, early morning if you're east of us, and hopefully see you the next time.
Super.
Thanks for having us.
Thank you, guys.
Appreciate it.
Bye-bye.
Bye-bye, everybody.